Hello, everybody. Welcome to the presentation of Altamir's 2021 results. Let me introduce Maurice Chéniaud, Chairman and CEO of Altamir Gérance, and Eric Sabia, CFO of Altamir. Maurice?
Thank you, Claire. Good morning, everyone. 2021 was an outstanding year for the private equity industry in every respect: fundraising, investment, divestment, valuations, IPOs, and a year to be reminded. Just to provide you with two numbers, on page 10 of our presentation, you will see that in terms of investment, the open buyout achieved 466 billion of investments compared to 187 billion the previous record year in 2020. In terms of divestment, again on page 11, 251 billion worth of divestments through M&A, but as you well know, there are three routes for exits in the private equity industry. M&A is one of them, but IPOs are a very large route, and 2021, the IPO market was the most brilliant market we have ever seen in the history of our industry. And obviously, the debt market was also very active through dividend recaps. So an outstanding year for the private equity industry. In that market, on page 13, we are pleased to report that Altamir had a very strong year. In terms of NAV growth, we registered a 25.9% growth, dividend included, compared to 13.7% a year pre-2020. That performance was driven by the EBITDA growth of our portfolio company, where the achievement was 22.6% compared to 13.1% in 2020. We had a record year in terms of divestments with 636 million, i.e. more than 4 times the previous year. 18 new investments compared to 8 a year ago, and for 369 million worth of investment, again 3 times the previous number of 113 million in 2020. And we ended the year with 163 million of cash compared to 42 million. Let's dwell in more detail about those numbers. On page 14, you see that we exited 9 companies for a total 573 million, bringing the total to 636 million. I would like to stress the fact that 636 million worth of divestment is 50% of the opening fair market value of our portfolio at the beginning. We have sold half of the fair market value of our portfolio at the beginning of the year. And on page 15, you see the 9 full exits, and 2 of them, Marlink, Unilabs, are signed, but will only close in 2022. And basically, we ranged from 1.4 times our money to 3.1 times our money. I would like also to stress the fact that obviously we reinvested in Experio and Marlink, and obviously we repurchased the Tom Group. Moving, and on top of these full exits, we had 63.5 million of proceeds from partial exits, and most of them were due to IPOs. Footworks went public, Genius Sport, Paycor, Baltic Classified, and Inmarsat was also sold, signed, but not closed yet. Moving to the investment activity, on page 17, we invested in 18 new companies for a total of 340 million. And on page, and again, record year compared to 2019, where the record was at almost 200 million. And on page 18, 19, and 20, we present you the 18 companies in which we invested. You will see that 9 out of the 18 were in the tech and telco sectors, 3 were in the services sector, 4 were in consumer, and 2 in healthcare. In terms of geographies, 9 companies were 9 countries, US and Canada, and 7 European countries, France, Belgium, Netherlands, Italy, Germany, Spain, and the UK. Those 18 companies are all mid-sized, fast-growing companies where our objective is to build leading companies, to transform them from good companies to great companies. Moving on top of those 18 new investments, we had a few follow-on investments, mostly in Destiny and InfoVista, in order to finance major build-ups, transforming build-ups. In total, as you will see on page 22, our NAV per share at the end of 2021 was 37.81 euro. If you add to that the €1.09 euro paid in dividends, this brings the growth to 39 euros per share compared to 30.90 euro, i.e. a 25% NAV growth. I'm now leaving Eric to Sabia, our Chief Financial Officer, to tell you how that value creation was achieved. Eric, it's up to you.
Thank you, Maurice. Hi, everyone. I will start with the NAV bridge, the bridge of the value between 2020 and 2021. And we will start, of course, on page 23 with the value creation. The first item is the value creation. It can be split in 2 parts. The total of 387 million euro can be split into 2 parts, the realized and the unrealized. The realized part is mainly linked to the many exits Maurice mentioned just before. We have a total of realized gain of 69 million euro. On the unrealized side, we have a value creation of 318 million euro, and in that 318 million euro, 19 million euro is linked to the FX impact. Of course, linked to this value creation, we have a carried interest provision for 69 million euro. This is, of course, due to the strong increase in the value creation. This value creation of 387 million euro is a return of 34.3% on the 2020 NAV at the end of the year. On top of that value creation, we have fees, both direct and indirect, for 33 million euro. We have the financial results, which is positive this year for almost 7 million euro, and the dividend paid out, of course, impacted the NAV for almost 40 million euro. And this brings us to the total NAV at the end of 2021 for 1,380.4 million euro.
Eric, just to mention that the 69 million of realized gains doesn't represent the difference between the purchasing cost and the divesting cost. It's only the uplift compared to the fair market value at the beginning of the year. Am I correct,
Yes.
Eric?
Yes, thank you, Maurice. Thank you mentioning that. If we move on to the next slide, page 24, you have the value creation by sector. 80% of the value creation is linked to 2 sectors, tech and telco, and consumer. The 2 main sectors are those 2 ones, and among the tech and telco sectors, we have mainly 4 winners: InfoVista, Thoughtworks, Destiny, and Greytech. And we have 1 company which is which have a negative impact, which is Marlink. This is due to the partial sale of the company, which occurred in 2021, but which will only be closed in 2022. And this partial sale has been made at a value below the 2020 marks we have in our books. On the consumer side, most of the valuation is coming from the revaluation of Tom Group, which made a very good year. The rest of the value creation is split between services and healthcare. On the service sector, the value creation is very well split over the many companies we have. But Antoria is at its low point now. It's almost in a turnaround mode, and it should be back on value creation this year in 2022. I mean, on the healthcare, we have only one company which have a negative impact, which is Innovage, and this is linked to the fact that the company is listed and the stock price was low at the end of 2021 compared to the 2020 marks we had in our books once again. Moving on to page 25, we can see the many levels and the levels that have been used for the creation of the unrealized value in our portfolio, the 318 million euro. We are proud to report that most of the value creation is coming from EBITDA growth. We have, of course, a small impact of multiple of almost 60 million euros, but most of the value creation is coming from the EBITDA growth, which is the most important for us. 330 almost 7 million euros is coming from EBITDA growth. On the right of the slide, we provide you with the portfolio bridge at fair market value. The portfolio of Altamir is increasing by 16.5 million euros compared to 2020 value. And despite the many exits that occurred during the year, we have managed to keep on investing and creating value. We have invested 307 million euros, and the value creation, which I mentioned just before, 318 million euros, brings us to the total portfolio of 1,476 million euros at the end of 2021. Moving on to page 26, we provide you with the detail of the portfolio at cost, and it's a very important topic for us because we want to be as much invested as possible, and we can see that once again, despite the many exits we have made this year, we have increased the total cost of the portfolio by almost 10% compared to 2020. And it's worth mentioning that the split between the sectors is very stable compared to 2020 once again. Page 27, we provide you with the valuation methodology used between 2019, 2020, and 2021. At the end of 2021, the portion of a listed company has increased. Once again, it's linked to the many IPO that occurred in our portfolio during the year. We can mention Tartworks, Paycor, Genius Sports Group, Baltic Classified, or Innovage. Now, at the end of 2021, 11% of our portfolio is valued based on the listed stock price. Page 28, we provide you with the uplift. This uplift at the end of 2021 is at 13%. And I would say despite the two exits of Marlink and Tom, Marlink, which has been made, as we have seen before, at a lower mark compared to our 2020 FMV, and Tom, which has almost created no value over the year because the price at which we sold the company was almost already recorded in our 2020 FMV as the exit has been announced last year. Page 29, we provide you with the commitments of the company at the end of 2021. The outstanding commitments are at 534 million euros, and it's just important to mention that because in order to remain well invested, we must keep a very good level of commitment. And on the 2019 commitment made by the company, we have an outstanding commitment of 471 million euros, and it's important to mention that among this figure, almost 300 million euros have already been invested by the underlying fund, Apax Mid-Market 10 and Apax 10 LP, but have not been called by the fund yet. Moving to the cash position, we have at the end of December 2021 a very strong cash position of 173 million euros in the statutory books, and on the IFRS cash position stands at almost 60 million euros. This amount will increase soon by 11 million euros as we will receive 11 million euros, 11 million euros from the SPV we have at the company, which is Astra, and we will transfer the commitments which are, I would say, held on behalf of Altaroc 2021, and we'll transfer the commitments today made by Altamir for almost 34 million euros. This will bring the total cash of the company to 210 million euros at the end of April almost. And on top of this important, significant level of cash, we have 90 million of credit facilities available to date. I now hand over to Maurice, who is going to detail the strategy.
Okay, thank you, Eric. So another significant event took place in 2021, which is significant progress in our diversification strategy. As you will recall, I had announced in 2018 that we would continue to invest primarily through the Apax LLP or Apax mid-market funds and through the funds and alongside those funds, but we wanted to take advantage of our evergreen status by making long-term investment, as well as exposing ourselves more significantly to the US and the Asian markets. So in 2021, we made the significant investment in Tom Group, 100 million, which we led, and similarly, we decided to back the Altaroc Global Vintage Funds, a venture launched by Amboise Partners, who is our investor, is the investor council, and we decided to commit 90 million to the first 3 vintage Altaroc Global Funds. So the Altaroc strategy is really to offer retail investors the best of worldwide private equity, 40% Europe, 40% US, 20% rest of the world, by investing 80% of each fund's assets in 5 to 6 top-ranking GPs and making some co-investment alongside those funds. The benefit for Altamir of backing Altaroc Global is to access top-tier managers which require high minimum investment amounts as well as significant follow-on investment capabilities. Therefore, we expect through the Altaroc strategy to build long-term relationship with the managers of these funds and ultimately for Altamir to invest directly in those funds, not going through the Altaroc funds. As a first step, if you move to page 32, we committed 30 million to the Altaroc Global 2021 Vintage Funds, which had a final size of 180 million, and that gives us access to 3 new managers, General Atlantic and Insight Partners, 2 US-based managers with a global investment strategy, buyout and growth companies in the same sectors as Apax, and with Nordic Capital, and buyout funds specialized in tech payments, healthcare, and financial services. So we expect that to be a significant movement for Altamir going forward. Moving to page 33, as you may know, we suffered the sudden death of Jean Guilloyer, who had been the chairman of our supervisory board for 5 years, and obviously we miss his loss. And the board has appointed Dominique Cerruti to replace him, and Dominique will bring a lot of value to our board. He has a strong international operating experience in the tech sector, having worked more than 20 years with IBM and having been the chairman and CEO of Altran, a portfolio company of ours, and we know Dominique very well. The final point, which is important to signal, is that due to our strategic move, we have had to revisit our accounting status, and basically we have to adhere to the IFRS 10 accounting standard, which unfortunately doesn't provide us with a fully transparent presentation that we have accustomed you to use, i.e., where we present the gross investment performance on one of the portfolio companies on one hand, and all the costs presented on the other hand, whether those costs are borne directly by the listed entity or by the underlying funds. So in view of this change of accounting standards in terms of our IFRS accounts, we have decided to provide you with management accounts, which will provide you with the same information than we have always provided you with, and starting in 2021, obviously. Moving to page 35, events post-December 2021, nothing significant to signal. 2 new investments by Apax 10 LP, 1 new investment Apax Digital, and obviously the investment, the 30 million investment in the Altamir Global 2021 commitment, to the Altamir Global 2021. Obviously, we are all very sad of what is happening on the Ukrainian front, but from a business perspective, I just want to say that our portfolio has no significant exposure to both Russia and Ukraine. However, it's clear that this conflict will have an impact on the global economy and could affect both the valuation of our portfolio companies as well as the performance of our portfolio companies. So obviously, we will keep you updated on what happens. Moving to the portfolio, as you know, I like to say that the value of your company is the value of its portfolio. On page 37, we are pleased to say that we, at the end of December, Altamir had a portfolio of 65 companies, representing a fair market value of almost 1.5 billion, with 9 direct investments representing 26% of the portfolio, and 41% of the portfolio invested through the Apax mid-market funds, and 32% with the Apax LLP funds. On page 38, we provide you with a breakdown of the portfolio, both in terms of sectors, vintage, and geography. And I'm pleased to say that 50% of our portfolio is invested in tech and telco, and the rest being rather evenly split between sectors. By vintage, again, a good dispersion, which will provide future liquidity. And by geography, 79% of our investments are in Europe, and 16% in the US, and 5% of the rest of the world. And so obviously, we expect to change the balance of this geography through the Altamir fund strategy. On page 39, we like to say that the strategy of Altamir is to back fast-growing companies, and we measure that by the EBITDA growth compared to the non-financial companies of the CAC 40. For the first time in 2021, you can see that the CAC 40 is growing faster than the Altamir portfolio. However, if we combine 2020 and 2021, the Altamir portfolio is still ahead in terms of growth compared to the CAC 40 non-financial companies. On page 40 and 41, we give you a breakdown of the portfolio at cost by sales growth and EBITDA growth, and you will see that 31 companies representing 88% of the portfolio at cost exhibited a positive sales growth, and 24 companies representing 72% of the portfolio at cost exhibited portfolio positive EBITDA growth, and with a number of companies representing more than 50% of the portfolio at cost growing their sales and EBITDA at more than 20%. On page 42, we provide you with the multiple at which EBITDA multiple at which we value our companies at the end of 2021, and you can see that despite the fact that 50% of our portfolio is in telco and fast-growing companies, our multiple is at 13.6 times EBITDA, which is relatively modest compared to most of our colleagues in the private equity industry. And in terms of our total debt leverage, we had a slight increase of leverage, but again, quite reasonable. On page 43, we provide you with a breakdown of the portfolio with the 20 largest investments representing 78% of the portfolio at fair market value. As you will see, those 18 out of these 20 companies, only one, i.e. Antoria, is valued below cost. All the other companies are either valued at cost because they are recent investments or well above cost. And you can see that the other companies are all also valued at above cost. I will go through 10 of our largest portfolio companies and highlight the major event. Regarding Marlink, the key information obviously is the partial exit that we have mentioned already. But I would like to stress that Marlink is performing very strongly, and for the first time, the growth of the VSAT segment has outperformed the low band, and therefore this translates in a positive sales growth, which was not the case historically, while obviously EBITDA growth continues to be very strong. Regarding Infovista, the company has repositioned itself as a pure global networks business through both the acquisition of Amperix and through the divestiture of a global enterprise business. Destiny is really, through 4 major acquisitions, has become a leading player in Europe in UCaaS, and the business is performing strongly as the numbers show. ThoughtWorks went public in 2021 and is today valued at more than 10 times our cost. Greatech, strong performance, and both the strategy being followed is to really accelerate synergies with the Autodesk solution for the IP solution, proprietary solution of the company, and we are working very hard to achieve that. Odigo, the numbers are not great, but strong progress has been made in 2021 to transform the company to a pure SaaS provider, and we expect that 2022 will show the positive results from this move. Moving to page 49, Antoria, which is the second largest wholesale broker specialized in supplemental insurance protection for self-employed people, is our problem situation. And as you see, the numbers are not great, minus 16% in revenue, minus 39% in EBITDA, but the turnaround plan is really being implemented by the new management team that we have put in place, and we expect 2022 to provide the first significant results of this turnaround. If you move to page 52, Tom, as you recall, is an investment that we had in our books as a minority shareholder alongside Bridgepoint for 10 years. In February of this year, Altamir repurchased the Bridgepoint interest and became the leading investor in the company by reinvesting 100 million euros into the company. And I am pleased to report that Tom reported spectacular results for its fiscal year, which ended in September 2021, with 6% sales growth and 19% EBITDA growth, while during that period, a number of stores were locked down and closed. And the company started its new fiscal year, the last quarter of the year, which is the most important quarter because it is the Christmas quarter, with very strong results, and therefore we expect the 2021-2022 fiscal year to be a very strong year again. And the company also generated a lot of cash, both the EBITDA growth and the cash generation allowed us to double the value of the company in terms of fair market value at the end of December 2021, 100 million becoming 211 million. Snacks Development is a leading European producer of private label savory snacks. It's a company which is completely hit by the purchasing costs, both energy and raw materials. And so all the work which is being done to improve productivity is being offset by these developments. And obviously, this will be again in 2022, a company would be again hit by energy cost and supply costs. But we expect that the company, which is a leader, will be able to transfer these cost increases into the selling prices. And finally, I think I have covered most of the other companies. And so if you would like to move to page 58, we provide you with the performance of NEV total return growth and as you can see on this chart, that over 10 years, 5 years, and 3 years, Altamir is outperforming its peers, the LPX Europe NAV, and we have delivered over 10 years 15.3% and a NAV total return compared to 11.6% for our competitors, and 18.5% over 5 years compared to 13%, and 24% compared to 14.7% over 3 years. And only last year we achieved a lower performance than our peers. But as you can also see on this chart, is that the performance is improving regularly over since the last 10 years. I would like to remind you that this performance is achieved with an intrinsic low-risk profile. We have a prudent financial strategy. We have no leverage at Altamir level, no other commitment, and no major currency risk on fund investments. We have only a few funds where we invest in dollars, but most of our commitments are in euros. In terms of valuation policy, I would like to stress again the fact that apart from this Marlink experience, historically we have never had a company sold at a price below our fair market value. And finally, we have a diversified and healthy portfolio, a portfolio diversified by sector, geography and maturity, and reasonable leverage in the portfolio. I remind you that we have a consistent dividend policy, which is to pay 2 to 3% of the year-end NEV since 2013. Last year we paid €1.09 which due to the discount at which the shares are trading represented roughly 4.6% yield. And the board has decided yesterday to recommend €1.13 dividends for fiscal year 2021, which will be paid in May. And obviously, it's a 23% compared to the 92 cents dividend of 2021, because I remind you that we paid in 2021 17 cents per share to reflect the fact that in 2020 we have not paid the full dividends. Moving to the total shareholder return on page 61, you see that again over 3 years, Altamir is overperforming both the LPX Europe index as well as the CAC mid and small. And again, last year, the LPX Europe is slightly better in terms of total shareholder return than we did. We are upset by that, and we will fight for it. But we are pleased to say that had you invested €1,000 10 years ago, that you would be rich today with €6,390. So I think we are pleased by that number. In terms of objectives on page 62, if you take a longer term view, since the inception of Altamir in 1995, so 26 years ago, we have invested 1.9 billion, and those investments have delivered almost 2 times money multiple and 16.2 IRR. And if you look at the fully realized portfolio, which represents slightly more than half the money, we have delivered a 2+X and a 15.9 IRR. And for the unrealized and partially realized portfolio of 834 million, we are presently valuing that portfolio at 1.9 times multiple and 22% IRR. Moving to our objectives on page 64, if you recall, last year we decided, due to the cyclicality of our business, not to provide you with only 1-year objectives, but a 5-year horizon. And we had committed to invest 170 million per year on average, to divest 230 million per year on average, and to deliver an organic 7% EBITDA growth for our portfolio companies. And obviously, 2021 being an outstanding year, we have completely outperformed those numbers. But going forward, this is what we expect to deliver. Finally, I would like to say that why you should invest with us, with Altamir, we have a unique value proposition. We allow you to access the superior performance of the Apex Partners funds. We have a growth-driven strategy, a shareholder return strategy with both an attractive dividend and an attractive share price growth, a low intrinsic risk profile, an experienced and committed manager, and obviously we have a tax efficiency with our tax status. Claire, Eric, and I thank you for your attention, and we look forward to seeing you in person at the next meeting. Thank you very much and have a nice day.
Thank you. Bye-bye.
Bye-bye.